When we get digital capital, we can also build new things on top of it, right? Things like digital credit. Now, for centuries, the world ran on this gold-backed bonds, mortgages, and credit was always issued against some form of collateral. That's why you hear things like, what's Bitcoin backed by, right? Well, the dollar used to be backed by gold, right? It was credit. The collateral was the gold. So what's the dollar backed by? Well, it used to be backed by gold in the bank. Credit and debt is backed by something, right? Now that hasn't changed. What's changed now is the collateral. So instead of fiat, instead of real estate, instead of government bonds, we can now issue credit, the digital credit, against Bitcoin, right? Against the digital capital.
In the old system, credit was issued against gold. Later, it was issued against fiat currency, and then against real estate, stocks, and government bonds. But every one of those assets loses value over time. They're fragile, inflated, corruptible. Mark Moss introduces the next evolution, digital credit, a system where credit is issued against Bitcoin.
Most people think of money as something like this. Bills, paper currency, right? Something they'd keep in their wallet. Numbers on their bank app. But the majority of what we call dollars, they're not actually dollars at all. They're credit. You see, bank deposits are just IOUs, and they're backed by other IOUs. Like your cash is just a claim on someone else's balance sheet, right? The reason why is we're in a credit. We're more precisely in a debt-based monetary system. And new money isn't created by producing more value like it's supposed to. Instead, it's being created through debt issuance. So every time the government sells a bond, right, or a bank makes a loan, more dollars get created. That means the entire system rests on a foundation of debt. Now, the problem with that is that when the foundation of the financial system is government treasuries, fiat currency, right, or real estate, you inherit all the risks of inflation, counterparty failure, and debasement. Now, the capital itself is deteriorating while more and more credit is stacked up on top of it. So the real question is this, like, what happens when we rebuild the entire credit system, but on top of a new form of capital, and I'm calling this digital capital. And it can't be printed, it can't be inflated, and it doesn't deteriorate. We're talking about a new foundation built on this new digital capital, right? And if we think about it, as I said in the intro, right, we digitize books, we digitize music. Movies are digital now, right? They stream. And now we're digitizing money itself. And like every other digital transformation that we've seen, it moves faster, right? It's stronger, and it's much better than anything that came before it. And so Bitcoin is sort of like digital gold, but it's so much more than that. It's something gold could never be. It's digital, right? It's digital capital. So this new digital capital is the base layer of this new financial system that's being built. And unlike fiat, it can't be printed. Unlike real estate, it doesn't deteriorate. Unlike gold, it can be moved at the speed of light. It can be audited instantly, and it can be programmed into any financial system on Earth. It's incorruptible, it's scarce, it's permanent, and it's the perfect collateral for credit.
P. Morgan said gold is money, everything else is credit. This morning I said Bitcoin is money, everything else is credit. The success of gold is indicative of the demand of mainstream investors to have a bearer instrument that's a long-term store of value, that's not a currency derivative and doesn't have counterparty risk to a corporation. Gold fits that bill. Bitcoin fits that bill even better, and it's sort of got the digital upside. You know, you can't teleport gold, and you can't program gold to vibrate at 1,000,000 times a second on a computer. So Bitcoin is the technology version of gold. It's digital gold. It's going to be, in my opinion, 10x bigger than gold.
All right, that's the shift. We're moving from a world of fragile, inflationary credit built on top of a weak foundation to a system where credit can be issued against the strongest capital base humanity's ever seen. Now, Bitcoin it's like a lot of things, but what it is it's digital capital. And this doesn't just improve what we already have, it unlocks something entirely new. Okay, so now we have something new, right? We have this digital capital. And so now we can build new things. So whenever we get a new building block like steel, we can build things like skyscrapers and bridges. When we get digital capital, we can also build new things on top of it, right? Things like digital credit. Now, for centuries, the world ran on this gold-backed bonds, mortgages, and credit was always issued against some form of collateral. That's why you hear things like, what's Bitcoin backed by, right? Well, the dollar used to be backed by gold, right? It was credit. The collateral was the gold. So what's the dollar backed by? Well, it used to be backed by gold in the bank. Credit and debt is backed by something, right? Now that hasn't changed. What's changed now is the collateral. So instead of fiat, instead of real estate, instead of government bonds, we can now issue credit, the digital credit, against Bitcoin, right? Against the digital capital. Now this is what companies like Strategy, right? They're pioneering. They issued preferred equity, perpetual instruments, and they never come due. They're backed by their Bitcoin asset holdings. Now these trade like money, right? They trade like money market funds or savings accounts, but instead of paying you, say, 4% like a bank, they're yielding 8, 9, 10, even 11%. And here's why that's important, right? Traditional credit instruments like bonds or loans or mortgages, they're really fragile, right? They rely on assets that lose value over time. But digital credit is built on top of an asset that appreciates in value over time, an asset that can't be inflated or debased, right? It can be verified instantly.
So treasury companies, in essence, are holding digital capital and creating digital credit instruments on top of that digital capital. And there's, of course, a huge demand for equity and credit instruments in traditional capital markets. And Bitcoin is emerging as the ideal form of digital capital to back those instruments.
Now, so if you take a look, you can see what's actually happening here, right? The volatility of Bitcoin is being stripped away because these fixed income investors want the income. They don't want to see their portfolios swing 40% with volatility. They want stable yield. They got to pay their bills every single month. So by issuing perpetual preferreds, these companies can convert the Bitcoin upside into a credit instrument with steady returns and no maturity risk. I mean, if you think about what this means, there's no rollover risk. There's no margin calls. There's no forced liquidation, even if Bitcoin drops. Right? That's a fundamentally different structure than any other credit market that we've ever seen.
But if you're selling a perpetual instrument, I borrow $1 billion forever, and I agree to pay you, say, 10% dividend yield forever. The principal's never coming due, right? And the preferred stock, by definition, is a dividend. It's not a coupon. The board has to have the option to suspend it in duress. So it's practically speaking possible to take your leverage beyond 20% to 30 or 40% even, but you don't have the kind of credit risk you have when you have a bond or a margin.
That's a massive breakthrough. Digital credit turns Bitcoin into the foundation of a new fixed income system. And it pays a higher yield, it carries lower risk, and it's structurally more resilient than the debt-based credit system that we're living in today. And when you realize that the fixed income market is over $300 trillion, you start to see just how big this can get. And where this starts to get really powerful is digital credit isn't just another yield product. It's an engine that creates a feedback loop between Bitcoin and the credit markets. So here's how it works. Step one, a company like Strategy issues digital credit like a preferred stock or a perpetual note. Step two, the dollars raised are now used to buy more Bitcoin. Step three, that Bitcoin collateral strengthens their balance sheet, which allows them to issue even more credit. And then step four, the cycle continues to repeat. Now, every time this loop turns, more dollars are created, more Bitcoin is taken off the market, and the value of the remaining Bitcoin rises. Now, that rising collateral base means even greater capacity to issue more credit. It becomes a flywheel.
We're on the verge of the creation of a digital credit market that right now it looks like 20, 30 billion a year. It's 30 billion a year. And the Wall Street Journal and the New York Times, they haven't noticed it exists yet. But we're about to go to 50 billion and 100 billion and 200 billion. And so think about $1 trillion of credit. And when it's $1 trillion of credit, it's not 1% of the credit in the world, and people still don't notice it exists. And so the real opportunity for all these companies is to issue billions, then tens of billions, then hundreds of billions of digital credit.
Now, this dynamic is sometimes called a speculative attack on the dollar because as new dollars are being created through credit, they're immediately converted into Bitcoin, which then tightens the supply and it drives up Bitcoin's marginal price. More credit issuance means more Bitcoin accumulation, and that accelerates the shift away from the old system. So instead of a fragile debt-based system where inflation erodes the savings, you now have a system where the credit base strengthens every year and the collateral keeps getting scarcer. Now, if we take a step back And we look at the scale and we see what's happening, right? The global fixed income market, government bonds, corporate bonds, money market accounts, savings products, right? It's over $300 trillion. It's the largest asset class in the world, and it's all built entirely on debt. So of course, the system's fragile, right? It's low yielding, it's being debased by inflation, and in some countries, the yields are even negative. But digital credit changes the equation. Now, for the first time, the credit can be issued against an appreciating asset. That's the key piece. Against an appreciating incorruptible asset, digital capital.
What if there's $100 trillion of digital credit and hundreds, by the way, $100 trillion in digital credit backed by $200 trillion worth of digital capital would be not fractional banking, right? You haven't got to 1-to-1, you're still 2x over collateralized, which would be better than the very best AAA corporate investment grade debt in the United States is like 2.5 times or 2.5 times over collateralized. So it's all AAA investment grade, but with more yield and more transparency. So I see the end game as the credit markets are reinvigorated and digitally transformed to be backed by Bitcoin.
Think about that. Even if just 1% of the fixed income market migrated into digital credit, that's $3 trillion flowing into Bitcoin. At 5%, it's $15 trillion. At 10%, we're talking over $30 trillion. I mean, these numbers are so large, they would replace the entire global financial system. This is why digital credit isn't just another financial product. It's the Trojan horse pulling Wall Street, pension funds, sovereign wealth funds, all into Bitcoin, whether they realize it or not. Okay, so now that you see it, what does all this mean for you? Let's bring it down. Let's bring it down from the 300 trillion to your own savings account. Okay, so today your choice in fixed income, they're mostly broken, right? Savings accounts pay you basically 0, maybe up to 4%. Bonds lock up your capital for years and in return, 2, 3, 4%. Some countries, as I said earlier, they're literally getting a negative yield, meaning you pay the bank to hold your money. It's a system that guarantees you lose to inflation. But again, digital credit flips all this upside down. So now these companies can issue perpetual preferreds or money market style instruments backed by Bitcoin. That means that the yield goes from the 2 to 4% that doesn't keep up with inflation to now 9, 10, 11%. And instead of being debased away, the collateral, right, the Bitcoin itself, goes up in value over time. So instead of being risky, where most of this debt, this yield is under collateralized debt, now you get assets that are 5 or even 10 times over collateralized. So it's safer, you get higher yield. That's digital credit. All right, that's the key. You don't even have to be a Bitcoin believer to benefit from this. If you're a fixed income investor or just someone who wants their savings to grow faster, digital credit is already offering better yield, better collateral, and better structure than anything else that's in the old system. And as more and more of that $300 trillion pie shifts into digital credit, the upside gets amazingly strong.
By using Bitcoin as collateral, new credit instruments can pay yields of 8%, 9%, or even 11%, backed by assets that not only hold their value, but appreciate over time. These assets are often 5x to 10x over collateralized, meaning they're safer than traditional bonds, not riskier.